Hello and welcome to the Monday Futures Market Outlook for December 17th, 2012. This is Patrick Ceresna here. For those of you interested in trading futures every single morning and have not tried out our eminisource.com trading room, complimentary memberships are available on the website. In addition, we always reference the intermarket relationships of currencies, commodities, bonds, and stocks. We go into extensive detail in our newsletters to explain these relationships in greater detail. If you want to learn about our Market Timing Strategist newsletter, please visit the website. As always, we start off with a chart of the U.S. dollar index futures, and we continue to see the U.S. dollar slowly weaken down towards the bottom end of this range, where the supports of the last year's lows all came in around the 79 level, give or take. It is very likely at this point that the U.S. dollar can continue to deteriorate down into the support, but we're not necessarily convinced that the U.S. dollar has to make a material breakdown, especially into the early part of the year. So really at this stage we want to at least initially view this as a range bound environment where the US dollar is going to the bottom of the range and has room to obviously gravitate to the middle or top end of the range after it's gone there. So we will be looking for supports to hold as it approaches the downside targets. Next year, when we take a look at the euro, this is one of the major input variables to the US dollar, and this will be a very interesting input. If the euro is actually able to break to multi-month highs from the highs that it put in September, October, it immediately opens the window for the euro to be able to strengthen up to the different consolidation levels that it put in between February, March, and April, which are anywhere in the 133 to 135 zones on the upside. This would certainly allow the US dollar to weaken to 79 and really test those bottom zones if the euro is able to break the overhead resistance. Now we're going to be observing early this week whether or not the euro can make this strengthening move, because if it does fail to break out, then a return back to the 129 to 130 level would be just a very natural consolidation into the new year. Next year, I want to take a look at the 30-year Treasury bonds, and the Treasury bonds have come off their highs in a consolidation, but we're at a critical moment. If the uptrend is to resume in the 30-year Treasury bond, the supports would very naturally happen here in this 147, 148 level on that on those March Treasury bond futures. If the support levels hold, then there is plenty of room for Treasury bonds to strengthen not only back up to their highs, but even attempt to break to all-time new highs. But this is all dependent on the support holding. If we see price deterioration that breaks below this 147 level, at that moment consolidation down to the 145 or even 143 levels on the downside would be very natural, as we really have more of a bottom of the range, top of the range kind of price action developing in Treasury bonds. So let's watch to see if the support holds. So when we get into the world of commodities, and particularly copper here, copper actually has been the strongest commodity of them all so far. It's strengthened off that 142 support and is kind of consolidating in the middle of this range. We remain optimistic about copper, even though copper is right in the dead center of the top to bottom of the range. At this stage, if the US dollar weakness is a predominant trend into the first quarter, there's plenty of room for copper to retest not only the high from September around that 385, but also potentially $4 range, where it's the February March highs. Let's watch to see whether or not the support holds here during these consolidations. Next year, I want to take a look at crude oil. And crude oil is at a very interesting point. We were expecting crude oil to have substantially better strength during the last wave, just like when copper had the strength. But at the same time, crude oil is yet to break down. And there is room for crude oil in this consolidation to still yet bullishly break out. While we're not ready to be overly ambitious just yet, because a breakdown here would be cause some substantial damage. But if we can see crude oil strengthen above $90 and hold that price level, it may be a signal from the market that a new uptrend has commenced, and we could see returns back to those highs put in September near $100 on the upside. But we don't want to be too ambitious until we see strength above $90 on that front. Similarly, if for whatever reason crude oil was given a catalyst to break down below that 85 support, then at that moment we'd have to reside to crude oil weakening for a full double double bottom retest of that 79.80 level where the lows came in June, July. So this is why we don't want to. We want to remain relatively neutral and let the price action dictate the next short-term move. Next year, I want to take a look at gold futures, and we've remained relatively bullish gold, but the price action has been quite weak in the last few weeks, which is obviously psychologically testing the resolve to stay with this with the stance. Really, our perspective is no different than last week, which is that consolidations in gold need to hold above 1650, ideally above 1675, but any short-term selling that breaks below 1675 but then immediately returns back above would be perfectly fine. The bottom line is that, well, as long as gold can more or less continue to consolidate, even in the next week or two, is sort of holding these supports, then that still sets up for a pretty bullish first quarter. It would only take material price action deterioration below 1650 for us to become more concerned about gold. So finally, when we take a look at the S&P 500, we have a market that actually is holding up relatively well. Right as we speak, we're in that 14-15 area, more or less. Really, at this stage, we were suggesting that even short-term pullbacks, that even went as low as 1370, would not change our bullish stance on the market. Really, at this stage, all of the fear associated with the fiscal cliff has caused a lot of investors to feel concerned, but recognize that that a lot of the tax loss selling and all the other things that are driving the short-term weakness and concerns could all be put rear view mirror in the first few weeks of January, leaving room for a very robust rally. So really at this stage, any weakness that's being driven by fear may in fact result in a bullish opportunity to accumulate into weakness. So while we cannot rule out 20, 30 S&P points down on any given day from weakness that comes from fear, we still do not believe that this would be the beginning of a new sell-off. So when we go into the key intermarket observations, we remain relatively neutral to U.S. dollar. While we feel there is vulnerability, we don't feel that there's a lot of downside risk on the short term. Maybe the euro returning back to the 132 to 135 level would certainly allow the U.S. dollar some short-term weakness, but we think it'll be far more range-bound at this juncture. Commodities have room to strengthen, but we clearly have not seen things like gold or oil participate the way copper has. But we still feel that the risk-reward proposition of owning any of the commodities at these prices, the risk we're taking for the upside potential is still good. It's the exact opposite for bonds. And while the bonds remain in a primary uptrend, and there is still room for bonds to return back to their highs or even temporarily break to a higher high, the risk of actually owning these bonds when they're really yielding a negative real interest rates is a very poor proposition, and we certainly would not encourage any investors from owning them. But traders can potentially still scalp upside moves, but we don't want to rate that risk-reward proposition very well. In terms of U.S. stocks and global stocks, we remain optimistic, and while we do believe there is a short-term risk of pullbacks, we believe that the upside potential that lays into the first quarter is substantially greater than the risk we have of owning them. So we are at this stage remain with a good risk-reward proposition. That was your Monday Futures Market Outlook. Thank you for joining me.